Did the death cross kill the Santa rally? Hi, Dean Jenkins with FollowMeTrades.com, and this is the market update for the week coming up of December 10th, 2018. And so, I opened up saying, did the death cross kill the Santa rally? I guess I got to get my nouns and verbs defined and arranged correctly here. So, first, what is the death cross? The death cross is not an entity with any power to kill anything. It's a computed value. It's an observed indicator phenomenon, and it's the crossing of a lower time frame or lower interval moving average over a higher interval moving average. And then there's several different applications or settings for it. The most common on a daily stock chart is the 200-day moving average, which I'm showing here in this bold white line, and the 50-day moving average, which I'm showing here in this kind of light blue line. And you can see the light blue line, the 50-day moving average, has crossed over the 200-day moving average for the first time in a long time. And it did that after Friday's close, after the big drop in the market on the Dow and the other indexes. You have to go back quite a while to see this this phenomena happen, and we have to go clear back. The last time that we had the death cross, the 50 crossed the 200, was in early 16, and after the cross, you can see there was a bit of follow through to the downside. The cross happened right about here, so there was a bit of follow through. The market had already dropped a fair amount. It happened also back here in 15, right about there. And so, does this portend a bigger move down? I think we have to wait and see. It could. I think we have to take the death cross in context with the rest of the chart, and we're going to walk through this. But also, I talked about, did the death cross kill the Santa rally? What's the Santa rally? The Santa rally is not something that can be killed either. It is a sometimes observed phenomena that in December, toward the end of the year, the markets rally more often than not. Those aren't things that I trade on. I try to trade the reality of what actually is happening on the charts. So what is actually happening here on the S&P 500 chart that we're showing? Well, we have, and I've talked about this for weeks now, the S&P 500 has crossed under the 200-day moving average, and it went back above it, it went down below it, it went just above it, kind of bounced off it, we're down below it. We are in a pretty volatile channel right now. And so here's the upper boundary of this channel. And let me draw another line. Here's the lower boundary of the channel. So I don't think we can make any declarations about the trend until we break out of this channel, either to the upside or the downside. So death crosses and Santa Claus notwithstanding, we're in a channel, and it's very volatile. It's very wide. It's the top here is about 28.18, the bottom's 26.03. So we got just over a 200-point channel on the S&P 500, which 200 points is about 8%. So that's a pretty big swing. The S&P 500 is negative for the year, given Friday's close, down for the year just a little bit. And I gotta slip in that Follow Me Trades, the picks that I publish to my subscribers that I take on my own account. We're up 18% for the year, so feeling pretty good about that. We're beating the averages handily. But I think we got to break out of this channel before we can declare a direction. I'm biased to the downside, and the reason for that is we're about 10 years into a bull market. It looks like it's losing steam and running out, and it would be a natural part of the ongoing market cycle to get a correction. And we see some signs, momentum slowing, where each of these down moves is getting bigger. So from a technical standpoint, it looks like we are about ready to correct. And not a bad thing. Death Cross sounds kind of like a Star Wars movie or something bad. Death Cross killed Santa. It's awful. We can make a lot of profit in a bear market if you got a plan. If you're using risk control and a clear strategy, we can trade to this downside very safely. Pretty much in any kind of account. We got strategies for doing that, and we can make some nice profit. The we just trade the realities of what the market's doing. If it takes out this lower level, 2603 on the S&P 500, I think we got a bigger bear market coming. We'll be trading that. If it doesn't, if it ends up going to the upside, we'll trade that too. I think there's less possibility going to the top or to the upside, and if it does, I think there will be less dramatic market movement. Speaking of dramatic, there's a lot of things in the news coming up. Of course, the Fed, is having their meeting in about a week, week and a half. Jeremy Powell is going to announce whether they're actually going to do the announced rate hikes that were, already announced for December. If he, it's kind of, through the looking glass stuff. If he does it, a lot of people think, that would really be a bad thing, that, the economy doesn't need, tightening of funds and higher interest rates. But if he doesn't do it and he backs off, that means that the economy's in trouble and he thinks there's a recession coming, and he, who knows? You can start kind of second guessing it. That's why we focus on the realities of price action and technical analysis. But we got the FOMC meeting coming up, planned rate hike for December. Of course, the ongoing trade war. U.S. just arrested the CFO of a Chinese company, trying to think of the name of it, supposedly for violating the Iran sanctions. China is promising severe consequences if she's not let go. We'll see how that plays out, and that's against the backdrop of a larger trade tension between the U.S. and China. Of course, Brexit's in play, and government shutdown. Congress has to decide on a budget. They passed a couple-week continuing resolution, so more games being played there. So there's always something in the news to make us worry about what's going to happen in the market. Again, I think it's best to stay focused on technicals and the reality of price movement. And the reality is we're in a channel. If it breaks down below this 2603, you can bet I will be shorting that, and I'll be talking about it quite a bit. And if it goes above, we may have more highs to come. So we'll watch. Meanwhile, there's individual trades that are good. We're taking them. We're getting some profit. We're going to wrap the year up pretty good here. So I wanted to look at gold before we wrap it up, because gold is looking bullish. And in times of uncertainty, there's this flight to quality phenomena. You can see, most of the 2018 gold got crushed. Really nice high, higher, low, high, higher, low, off to new highs. We got a target, target zone up to 1300. The midpoint's about 1275. I'm already long some gold stocks and may take a few more, and we're already in pretty nice profit. And I think there's a bit more to go here on gold. And what about oil? Big drama, big moves in oil. Pretty interesting after the dramatic drop of oil from over $76 down below 50 for just a moment. Now we got this little pattern at the bottom of a high, higher, low. And maybe if we put in a new high, if we break out of this little area here, call it 54.60, we could be seeing oil retrace up to a midpoint of the low 60s. So let's watch for that. If it breaks down, puts in new lows, that bets off. But high, higher, low, if it puts in a new high, that could be interesting. All right, as always, trade safe, use risk control, keep the winners big, the losers small, and we'll catch you at the next update. And if anything dramatic happens, I will send out a special report. Thanks.